Good evening, everybody. Welcome to Zoom at 8. My name is Julie Ann Peterson, and I am your host every Tuesday night. You know, we have been doing Zoom at 8 for 5 years. How is that we have been talking with industry experts and networking for all 5+ years? And boy, have we gone through a lot. COVID, and now we, have this inflationary environment that we're in. What is next? Are we going into a recession? Boy, oh boy, if my crystal ball worked, I could really make some money on figuring out what's next. Anyway, I'm with Old Capital. I have been with Old Capital for 11 years. We are specialists in multifamily, but we will do other asset classes. So if you're looking at a deal and you're thinking, this works, this is going to, I'm going to put in an LOI. That is the minute that you pick up the phone or you send Julie an email, and I can underwrite it as what the lenders are going to provide in terms of proceeds. Because at the end of the day, your lender is your biggest partner. We are the ones that are bringing the most amount of money. I don't think you're going to bring an investor. Maybe you are, but 70%, 80% on some of these deals. So we want to have a good underwriting for you. So give us 48 hours before you put in that LOI and get to know where this asset really can come through, and do your returns work for your investors. Don't go in blindly. I've seen it too many times and it fails. So tonight I'm excited. As you know, I always am excited on a Tuesday night, because tonight we're going to talk about funds. There is a huge trend to funds, and fund to funds, for all of these different 506C, 506B, Reg D. We're going to learn about those tonight. Matt Burk is with us from Verivest. So it's kind of like a fund in a box. You can get it all done through Verivest. So if you're not familiar with what a fund does and the power of a fund, especially when you say to a syndicator, hey, I've got $5 million in this fund and I'm going to bring it to you, and you're going to have that capital raised quickly, you are now seated at the table on a deal. So tonight we have the great pleasure of meeting up with Matt Burk with Verivest. If you're not familiar with Verivest, or you're not familiar with the fund model, tonight is going to be super helpful for you. Matt Burk is the founder of Verivest and Fairway American Investments. He's a seasoned real estate executive, chief investment officer, and fund manager who started and managed 11 real estate asset-based Reg D pooled investment funds over more than 30 years. He has a discretionary underwriter approval authority of thousands of real estate asset-based investments with total asset value in the billions, including pooled investment funds, real estate secured loans, syndications, participations, GP and LP equity investments, and more. And he is the author of Capital Attraction, the Small Balance Real Estate Entrepreneur's Essential Guide to Raising Capital. And we need to know how to raise capital in this market. So Matt, welcome to Zoom at 8. We are so glad you're here. How are you?
I'm good. Thank you for having me. I appreciate that. That's you read off my bio that makes it seem a lot more impressive than it really is. But thank you for doing it.
Well, you are impressive. So you stand behind, I'm sure, a lot of these big words, and you really are very educated in this arena, and so valuable to so many of our listeners. If everybody would do us the favor and go up to the right-hand side of your screen and choose speaker view, you'll probably see me. You don't want to see me because you want to meet up with Matt Burk here. He is our industry expert, and we bring some amazing experts. And we've had Verivest here before in the past, but things have changed. We are getting more and more understanding of where the fund model is going, what it's about. And I got to have this all information coming from Matt. So, Matt, tell us more about fund management and why we would do this, and the, the all of the aspects of making this a viable solution for syndications.
Sure. So, you want me to share my screen,
Sure.
Julie? And
Sure.
so maybe before I do that, I'll give folks a quick background on myself that's a little more tangible, so you understand. Well, where I guess why I would be qualified to speak on it. So I started off as a private lender years ago in the mid 90s. I did a lot of individual loans, first trust deeds, and I would raise the money one investor at a time, one trust deed at a time, match them up, keep the servicing, etc. At some point, we were doing enough volume where I felt like it made sense. I heard about a fund. Okay, what's a fund? I didn't know what that was, but I started doing one. I launched my first fund in 1999. I made a bunch of mistakes, hired a lawyer to set up a fund document, didn't know what I didn't know, had to redo the documents, etc. But eventually, about a year and a half later, and tens of thousands of dollars later, we launched the fund, did fund one, ultimately did fund two, three, four, and then the Great Recession happened. The great financial crisis happened. We had, at that point, a large line of credit with Wells Fargo Capital Finance that had a senior encumbrance on that fund. They wouldn't renew it, and I had to wind the fund down. And so that was a very painful experience. Had to go to all my investors and tell them that, look, I have the assets are fundamentally good, but the capital structure, I'm going to have to wait. And deal with all the investors and so forth. And so I had to kind of reinvent our business model. And through that process, Julie, at that time, I had several people that came to me and said, hey, Matt, I know you've run some funds and set them up and winded them down. And I'm thinking about setting up a real estate fund or a lending fund. What do you think of this? And what do you think of that? And at the time, I realized that there was a pretty good market for people who needed business advice, not necessarily legal advice. Legal is important. You have to have the legal component, but it's just kind of table stakes. I found that a lot of people didn't really know how to match the asset model to the capital structure. And I always think of a fund it's like a wheel, right? And the legal is just a spoke, right? The accounting is a spoke. The origination is a spoke. The asset management is a spoke. Loan servicing is a spoke. Investor relations is a spoke. Capital raising is a spoke, right? So tying all those things together, a lot of people didn't really know how to do it. So we kind of launched a advisory practice helping other entrepreneurs, GPs, sponsors, lenders setting up their own pooled investment fund. This was 2012. And since that point in time, we've played the lead role in advising upwards of about 325 funds around the country, and just about everything you can think of, from lending to tax lien certificates, hotels, office, storage, you name it, retail, multifamily, etc. All of that then gave rise to us doing the back end fund administration. Because once you run a fund, like how you account for that fund when you have assets coming and going can be tricky. So that gave rise to what is now Verivest, which is a fund administration business. So basically, fund advisory, setup, creation, and administration is what Verivest does. And that's what I would say is why I would feel qualified to speak to you intelligently about how, when, why to set up a fund, why not to, et cetera. So that's kind of the presentation that I had here this evening. So I'll go through this deck a little bit and talk to it if Julie if it's okay. If people have questions as I touch upon a certain topic, if it resonates or you want to ask something, please do. If I'm going to cover it later in the talk, I might defer, but otherwise, I really prefer an interactive session. So I'll try to answer people's question and provide as much value as I can to folks. So with that said, let me see if I can share a screen here. I'm a real estate person, not a tech person. So we'll see how that goes. Okay. Can you see that
Yep,
now?
it's coming. Yep, there it is.
Okay. So private real estate investment funds, what are they? How do they work, et cetera? Let's see. So disclaimer, I'm not a lawyer. This is not legal advice. This is all very practical advice. I've dealt with many securities lawyers more than I care to recount, but this is not legal advice. This is just practical business guidance. So an overview, how do I define a fund? What's the difference between a fund and a syndication? Who uses them? When and why? What are some of the pros and cons? Touch upon different fund structures, open and closed. Describe some of the typical fund terms. Some of the considerations around when you launch a fund, what are you looking for? When you're managing, or what are you looking for? So those are some of the things that I'll touch upon. So first is, what is a fund? I find there's a lot of what I would characterize as, people throw the term fund around a lot. It's not always a fund. The way I define a fund is that it has both multiple assets and multiple investors. So if you have a single asset and multiple investors, that's not a fund, that's a syndication. If you have a single investor and multiple assets, that's not a fund, that's more of a managed account. But a fund has both multiple investors, multiple assets, and oftentimes it's a blind pool. You hear that term, blind pool fund. That means the investors don't typically know which assets are coming in and out of the fund. They give the fund manager the discretion to pick and choose the assets inside of a particular defined investment strategy. And investors generally in a fund are all pari passu, which means equal treatment, pro rata, based on their ownership percentage. So funds versus syndications, I get this a ton. I would say most GPs or sponsors, managers start off as syndicators, doing deals one at a time. So you have a single deal that you're raising capital for from multiple investors. It's simpler. There's fewer moving parts. From an investor standpoint, they get to pick and choose which asset they want to put the money into. They also have concentration of risk, right? They don't get the diversity they would in a pooled investment fund. And generally in a syndication, there are no redemption rights. There's no ability to get your money back until the asset sells. A fund is considerably more complicated on multiple fronts, both operationally, administratively, accounting wise, capital raise wise. It just has more to consider than a single asset syndication. There's a lot more issues for the manager and the investor to try to understand. It does provide the benefit of diversifying the risk for an investor across multiple assets. And depending on the type of fund, in some cases, there are the ability for the fund or for the investor to request and receive redemptions before the fund has run its entire life. Not always, but sometimes. And again, and I don't know if there's an easy way to ask questions, Julie, if you want people to type in the chat or just speak up
either way. Paula asks if you've ever been interested in family office, if that would also apply here.
Yeah, family office I would characterize as a type of investor that generally would, and again, people use the term family office in all kinds of different ways, but fundamentally it's a family run investor who has reached a significant degree of wealth and may have an individual working for them and so forth. But I'd say a fund or a syndication, families will invest in both funds and syndications. So it's kind of a different topic. It really refers more to a type of investor than whether this is more of the type of entity that you're operating as the investment vehicle. Does that make sense?
Yeah. Do you have international investors in your funds, like 5 to 10 million? Is that something that you guys do?
It can be done. It's not easy. It can be complicated depending on what country they come from. Some have treaties with the U.S. and they can invest directly. Many don't. So you have to have intermediate, feeder and blocker vehicles, which are expensive to set up, expensive to run, complicated, and they generally don't make much sense unless you're dealing with very large dollar amounts. the cost to set them up and maintain them and run them is just not worth it if you're only dealing with relatively small amounts of money.
Good answer. Good question. Good answer. Thank you.
So who uses a fund? I'd say generally speaking, and we focus on real estate funds, but there are any number of different types of funds: private equity, investing in businesses, venture capital, hedge, and other types of funds. We focus on real estate funds. I would say that funds generally are used by people who have a certain amount of experience and have done enough syndications and deals that they've reached some size and scale. Setting up and running a fund is not cheap. I mean, it definitely costs money, and in order to justify the costs, you need to have a certain level of size to make that work. It is a sophisticated investment vehicle that not every manager certainly is capable of handling and managing. And I tell people all the time, first thing I do when I interview or talk to people is qualify them and try to give an honest opinion of whether I think they're ready for a fund or not. And in many cases, the answer is you're probably better off just doing syndications. There's absolutely nothing wrong with syndications. It's just different than a fund. So it's definitely not for everybody, but it can be a very effective vehicle for the right type of manager and investor. As I said, kind of in the lead in, there's all types of real estate funds. Fundamentally, you've got cash flow producing kind of core plus, and then various levels of value add, opportunistic and more rescue type funds. These will vary considerably depending on the state of the market. You are seeing a lot of rescue funds getting launched these days. People that are trying to put money into, pref equity, mezz, coming in and trying to pick up the pieces of deals that haven't worked out very well the last couple of years. That's very popular today. There are many types of, in every asset class you can think of. I'd say some funds are very focused on a particular vertical, let's say all multifamily, or even all multifamily garden variety, garden style, class B, C, suburb, post 1950. You can make your mandate as broad or narrow as you want and as you think you can raise capital for. The structure of the fund, the economics of the fund may vary depending on a variety, on the asset type, how long you plan to hold it, what you're planning to do with it, whether there's likely to be cash flow or not along the way, et cetera. And then there's, as I have on the right, debt funds. There are a lot. Debt is actually a very conducive asset type for a fund. It's actually, and that's where we cut our teeth, right? The first fund I did and the first 5 funds that we did were all debt funds. They're actually considerably easier on many levels. But the point is, if you're running a real estate business and you're raising capital from investors, a fund might make sense depending on the type of asset you're doing, the volume of assets, how you raise your capital, et cetera. So there's all different types. This is a question I get all the time is, pros and cons. Why would I do it? Why would I not do it? Right. And I've summarized them here in a few bullets on each. I think from the pro side would be it allows, and then I could even break this down even further into 4 sections that said, what are the pros for the manager? What are the pros for the investor? What are the cons for the manager? What are the cons for the investor? Right. So I've kind of mixed and matched these here, but it spreads the capital across multiple assets and gives diversification for an investor. As you all probably know, if you invest in a single deal, your performance is entirely dependent on that one deal. It could hit a home run and it could fall flat on its face, and you're completely subject to that one asset. In a pooled investment fund, you do 8 or 10 deals, 1 or 2 of them have a problem. That might be okay. If the other 7, 8, 9 of them do well, then being diversified, it's the classic example of diversification. From an investor perspective, there is generally more time to say yes in a fund because the raise period goes on longer than a syndication. Usually in a syndication, right, you have a hard closing date and a time frame coming up in 4 weeks, 6 weeks, 8 weeks, whatever it is, and an investor has to make a decision pretty quickly, before it gets filled up and so forth. Whereas in a fund, they generally will have more time to think about it. There's also a variety. Different funds are set up for different purposes depending on what they are. You can have tax advantage funds that focused on primarily tax benefits. You can have funds that are set up primarily to generate income, but don't have a lot of tax advantages. You can have funds that are set up to do primarily capital gains on the back end. So there's just a variety of different things that people can choose from once they know where to look for funds. It's a portfolio as opposed to a single asset. I touched upon that. And again, there is oftentimes some ability for the investor to get out of that fund if they want to prior to the end of that fund in an open-ended vehicle, particularly with mortgage debt. That becomes a viable option, whereas in a syndication that generally isn't. On the negative side, the investors do not typically have the ability to identify the assets that are going to go into that vehicle. So they're trusting the manager entirely to make the decisions on which assets to make or not make. And as a result, that's a higher bar of trust from an investor standpoint to get them to say yes to invest in that fund. The investor has no LP decision-making ability. They're basically along for the ride. And I would say it's a little bit more difficult for the investor to know exactly what's going on in the fund and let the manager. There's varying degrees of performance from the manager with respect to how good they are at communicating what's happening in the fund on an ongoing basis to investors. And that comes back down to investor reporting, right? How frequently do they report? How comprehensive is the reporting? Is it qualitative and quantitative, et cetera? And again, illiquidity generally in a fund, if it's a closed-ended vehicle, it's a lot like a syndication. You don't get your money back until all the assets are sold. And in a fund, it can be even longer, because if you have 5, 6, 7, 8 assets, right, you don't get paid all the way back until the last asset sells. I touched upon the difference between an open-ended fund and a closed-ended fund. An open-ended fund is a fund vehicle that is set up where the investors have the right to request a redemption out of that fund. It's always at the discretion of the manager. So the manager does not have to honor that redemption request, but can if they have the capital available to do so. It requires the manager to mark the assets to market on a regular basis, because in order to cash somebody out, you need to know what the value of those shares are, and depending on the type of underlying assets, that will drive how somebody goes about making the what they call NAV, net asset value, which you need to determine in order to be able to produce that fluctuating share price. Many mortgage pool funds are open-ended because, again, debt is easier to peg the value. It's generally the unpaid principal balance plus the accrued interest, unless the loan is impaired. Whereas in the value, when your fund consists of assets that are real estate, how do you know at any moment in time what that property is worth, particularly if it's a value add property and you're in the middle of construction, or you've torn apart and rehabbed it, but you haven't leased it up yet, right? So you have to have methodologies on how you go about valuing those assets in order to determine the share price. That can be a very tricky thing for a lot of managers to figure out. So valuation of assets is a key issue. Mark to market is a key issue, and you're always doing it with an eye toward what is the fairest treatment of both existing investors and new investors, and that should always drive people's methodologies on how they arrive at that. I do see a couple of questions in here I'll touch upon. For example, the customized funds that allows the investors to pick and choose which assets they invest in. There are what I've heard is called a customizable fund, which is basically a fund that an investor can make a commitment of dollars to, but then pick and choose which assets they want to invest in on an asset by asset basis. That is a relatively newer version of a fund. We have not done those. I know that they are out there, and I know that some people find them to be effective and attractive. I would say I always say this to people: there is no one perfect structure. Open versus closed versus syndication versus customizable. They all have their strengths and weaknesses. So there's nothing that is perfect, but yes, there are customizable funds out there.
So there is a couple other questions. Paula asks, can you give us an example of some of the questions you use to qualify your accredited investors for your fund, please? I have invested in several funds, but not one ever formally asked me any out of the ordinary questions that I can recall.
Well, I think, qualifying an accredited investor for a fund is similar, I would say, to a syndication. I mean, you really want to, in my opinion, you want to know, who are you? What are your objectives? That's the first question I always ask people, what are you trying to achieve? Right. And being intellectually honest about whether or not the fund that you're running achieves those objectives or not, and helping to try to match that investor. If most people are operating under the issuer exemption, meaning they are not registered reps that are licensed, with a Series 7 or a Series 63. Certainly those are out there, but most managers themselves, if they're selling their own fund, are not licensed. And so they do not have the same criteria for what's called, what's the word I'm looking for? Not accredited, but
sophisticated.
No, there's various levels, but suitability requirements. Because in the securities world, if you're selling securities as a registered rep, you have an obligation under those securities licenses to do suitability. Is this investment suitable for that investor? In which case, there are very specific questions that you need to ask in order to determine suitability. But usually that's beyond the scope of what most managers need to deal with because they're not licensed registered reps. So my personal opinion is you really just want to know, can they afford it? How much should they be investing? Are their objectives consistent with what you believe the fund to be producing? And if so, then they, relatively qualified. And obviously, and then I don't know how many people are familiar with 506C versus B. Right. Mm-hmm. It's like general solicitation and advertising. If you are using a 506C, then it is the manager's responsibility to verify the accreditation, not just take the investor's word for it. And there's safe harbor guidelines that the SEC has that tells you, what can constitute adequate verification. I don't know if that answers your question or not, but hopefully that's.
Yeah, I think that's very thorough. And based on your experience, that what happened with Wells Fargo after the GFC in 2008, have you changed the criteria that you use to choose bankers and lenders?
I'd say yes and no. I mean, certainly we did for a while. I think that at the end of the day, when you're borrowing money from a lender, you need to know how they're capitalized, right? And obviously the loan documents are important because at the end of the day, those are the controlling documents. In Wells Fargo's case, I mean, that was what's called a credit facility. A credit facility is a much more, let's put it this way, the loan agreement for that document for that loan was 175 pages long. So it was an extremely comprehensive document written by, high-end lawyers that cover everything under the sun to the favor of the lender. And fundamentally, those documents are not particularly negotiable. So I think you just have to go in eyes wide open, as a borrower that, you know what you're getting yourself into. I would say that we have set up plenty of funds where if they're relatively small, you can set up the fund with more than one type of security in there where you could have the senior credit facility consist of private individuals as opposed to banks. And those, I would call them covenant light, right? There's a lot less covenants that are going to be imposed upon the manager if you're dealing with private parties than if you're dealing with large institutional investors. So You just need to know who the nature of your lender is.
When you create a fund that invests in other syndications, like the feeder fund, do you advise it to be open-ended or closed type fund?
A lot of it depends on what you're investing into, right? Because I would say you want to, as best you can, match the capital structure to the underlying investments. So, for example, I'll give you an extreme example. If you buy a piece of property directly that you're going to do a value add, and it's going to take you 7 to 10 years to go through your business cycle, but you put together an open-ended fund structure that allows somebody to redeem after 2 years, how would you ever expect to honor that redemption?
Mm-hmm.
If the asset has no possibility of liquidity. Like, the only way to do that is to raise money from other investors, which is, you can do, it's legal, right? But it can be very difficult to get new money in from an investor in the middle of a fund, and what you end up with is just, okay, they thought they had redemption mechanisms, but they really don't. On the other hand, if you have a mortgage pool, if you're making first trust deeds and they're bridge loans, let's say on fix and flips, and your average deal turns every 6 months, and you're making a whole bunch of relatively small loans and you have high velocity of cash, that would be something that, okay, you probably could do an open-ended fund, because the money keeps coming through and recycles on a much quicker basis. So biggest thing I advise people to do is match your capital structure to your asset model as best you possibly can.
Yeah, it makes sense. That's all the questions. Oh, we have one more. What methodologies are used to value the fund when it invests in real estate assets, multifamily housing, commercial
Yeah,
products? Yeah.
that's a great question, and I won't give you a super long-winded answer, but I would say that the most important thing is that you establish a methodology that you follow on a regular basis. There is no one methodology that is mandated or required. So as long as it's, I'd say, reasonable and practical in the marketplace. So, for example, if you could use cost basis while it's going through its construction period, right? Because the NOI is not there yet, right? Then the income's not there because you're still in lease up, but you paid X for it and you spent Y to improve it. So you might use cost basis until you got to stabilization, and then you would convert to using cap rates applied to some net operating income. Or you might use sales comps, and you could use a combination of the three, and even others, depending on where the deal is at in its cycle. I'd say my best guidance is you have a written methodology that you use and you practice it consistently. And then when you do mark those to market on a quarterly basis, a best practice is you document why you did that. So it's always in the file so that you can support what those valuations were at any given point in time. Because of course, as time goes on, you can't remember 4 quarters ago, right? Why did I do this on that asset exactly? I mean, so yeah, have written methodologies, use market-based things like NOI, cap rates, sales comps, cost basis, etc. And it's all the same things that you would see in an appraisal typically, right? There's 3 basic approaches to value: appraisal, cost, sales, and income approach.
Great question. Thank you.
Yeah, and yes, you can change the methodology. And on the documents that we have seen lawyers written, you would say in the document something to the effect of, the manager shall determine in good faith the stated value methodology used to determine the net asset value on a quarterly basis. The manager shall have the ability to update that methodology over time, but shall always maintain a written stated value methodology that the manager shall make available to the investors, on an ongoing basis, something like that.
Can the LP transfer the fund shares to relatives?
I'd say the legal answer, and again, I'm not a lawyer, so this is not legal advice, but you would sign something as an LP restricting the transfer to anybody. But practically speaking, if you just want to assign it to someone else, most managers will be willing to accommodate that. It would require the consent of the manager based on the documents. Most of them will not withhold that. They might need to, if it's a 506C, they may need to verify the accreditation of that investor, so that you're not transferring it to an unaccredited investor, which is prohibited in the documents. But fundamentally, most managers would accommodate that as long as they're accredited and meet the criteria.
Excellent. All right, carry on.
Yeah, closed-ended fund, unlike open-ended, you take capital commitments up front and you call down the capital over time. Typically in an open-ended fund, somebody commits the capital, you take it all in, assuming you can deploy it. They may give you a commitment, but you'll generally take it sooner than later. Whereas in a closed-ended fund, you're truing up the amount that each investor has committed on an ongoing basis. So the whole capital call and capital true up and capital commitment process can be very, I'll say, novel and unfamiliar to many managers until you've done it a few times, and investors. So it can be a little bit clunky. That's definitely something to pay attention to. Usually you're not worried about NAV in a closed-ended fund because the share price stays the same. There's no real point in doing NAV. Everybody's buying in at the same price, although you may have you'll have a true up that would be usually the accrued but unpaid pref that people would have to catch up on. You have a defined raise period. So you would say, hey, we're raising money. Usually it's 12 months. Oftentimes there'll be a 6-month extension at the judgment or discretion of the manager. And then you'll have an investment period, which will usually overlap with the raise period. And that investment period can range from 3 to 5 years generally. And then you'll say, okay, after 3 to 5 years, we'll stop investing. We'll execute the business plan for these assets, and then we will move to the liquidation phase. That's another potential downside of a fund. Is, investors are generally expecting that eventually they're going to get their money back. So if the market is not good at the time that you're, telling them you're going to get them their money back, you might become a forced seller in a bad environment. Usually you'll have some mechanism where you have the option to extend for some time periods, but not forever. So that's why I say these vehicles, they're not perfect, right? They work well in certain instances, but they all have their limitations. And again, there's issues there that managers need to familiarize themselves with. I mean, this would be part, like if we did a fund creation engagement, this is a big part, especially for a first-time manager, that we would have conversations around, okay, how does the capital commitment work? How does the capital calls work? What are the economic terms? What does a manager catch up? How do I take the money down and time it with the deals that I'm buying and so forth? Those are all considerations that the manager needs to be aware of.
So I'm going to jump in here. I've had people open up funds and they only have one deal in that fund. You had mentioned that it's multiple deals in the fund. What would that, you say it's a syndication, but they are held separately. That fund is, quote unquote, fund is held separately from the limited partners that are coming in individually into the deal. A lot of the syndicators like that because it kind of separates these investors in that quote unquote fund. They only have to talk to one person who disseminates the information to their investors. So if you say that there's multiple, and people are saying, oh, I want to bring in a fund to your transaction, what do you consider that then? I know you said it was a syndication, but they're calling it a fund.
Yeah, that I would call that there's another word that comes to my mind, Julie, that I can't think of right this very second, but that is so it's basically a person went out, rounded up 10 friends or people in their community, their tribe. Somebody has a tribe, right? They have a podcast or a YouTube channel, or I see a lot of doctors, for example, or dentists, or somebody that leads a group of people. They bring them in, they form an entity. That entity comes in as a single investor into somebody's syndication. I would not personally call that a fund. That is itself, that's a syndicated single investment into another single investment, right? The manager, the syndicator who's running the deal probably calls that a fund because from their vantage point, right, they're only dealing with whoever the manager is of that entity and not the 10 or 15 or 20 people that are in that entity. right? But for the manager of that entity, there's only one investment. They're not managing multiple investments, right? They only formed that entity specifically to invest in that one deal.
So question comes up, is that considered, or wouldn't that be known as a fund of funds?
People use that terminology frequently. Yes, I would say that that would be something that, I mean, historically, the fund of funds would be somebody formed a fund and they made multiple investments in multiple deals, right? So if you form a fund, you get $10 million in commitments, you put $1 million in this deal, you put $2 million in that deal, you put $3 million in this deal. So that truly is a fund of funds, right? It's a fund that was set up to invest in other funds, not necessarily, there's a word that people have taken to using, because that's a relatively new phenomenon, Julie, I think, especially as you've seen more social media come around and a lot of folks have become, I'll say, capital raisers.
Correct.
Right? And have brought money into individual syndications, but the word is escaping me at the moment.
Yeah, so that is a popular scenario in this community.
Yes, very, very much so. And I wish I could think of the name. Maybe I will when I'm all done. But yes, fund of funds is what a lot of people would use to describe.
So is there a difference between fund of funds or fund to funds? Is there two different, or is that equal, same?
I think it's just nomenclature, right? That people use, and as you know, right, people will use the same exact words might mean something different to two different people. But I think it's common enough that, I mean, I don't want to split hairs. I mean, I think that a lot of people would call that a fund of funds.
Okay.
In what I would consider to be, a true pooled investment fund, multiple assets, multiple investors, this is what you would normally see, or for fee ranges. A management fee of 1% to 2% of assets under management is pretty typical. Oftentimes the GP, the sponsor, the manager, whatever you want to call it, will charge either an acquisition fee if they're buying property, or origination fees if it's loans they're making. And those can either be dumped into the fund as additional income in the case of origination fees, or the manager can keep it. That's kind of up to the manager, however they want to structure it at the outset. There's no legal requirement one way or the other. You just have to disclose it properly. And then oftentimes the GP will have they will be vertically integrated in some way, right? They have a property management company, they have a real estate brokerage, they have a construction company. And so it's common ownership with these other businesses, that the fund would then hire a related business with a common owner to perform services on behalf of the assets in that fund. And the fees will vary. Generally, I would recommend, and I see that most of the time those fees are consistent with market, so people aren't trying to gouge the fund, right? And in some cases they'll even charge the fund less than they might charge to a third party. But I'd say as much as possible, I encourage people to do everything at what would be market-based fees, one way or the other. The argument there being that, look, we can control the deal better because we're not only the manager and the owner, but we're also the we're the GC and we're the property manager, right? And sometimes that works and sometimes it doesn't. And I'd say it's done differently by different people, but these would be the fee ranges that I would see depending on what the manager wants to charge. Preferred returns, you'll see them. I mean, they've gotten higher as the market interest rates have gone up. You see a lot of deals going out right now with prefs of 9 and 10%. That was pretty uncommon a few years ago. You were seeing 5s and 6s. I think 8 is probably still the most common number. If there was a bell curve, I think 8 would be your peak. But I was looking at a fund the other day that they're doing a 12 pref, which from an investor perspective, that's pretty attractive. I mean, that can eat the manager alive if they don't have good cash flow, because those prefs accumulate, right? And over time, those prefs can get very costly to the manager. Profit splits. A typical institutional fund would be, let's say a point and a half management fee and an 80-20 split, right? And as you get down in the high net worth world, I think you'll see a lot more 75-25, 60-40s, et cetera. Sometimes you'll see an IRR hurdle. Once the IRR has crested a certain number, so let's say 15, 16%, then the split gets more favorable in the favor of the manager. Capital raise fees, a lot of funds don't have them. Some do. If you're running it through the broker dealer space, those fees can get very expensive, but it can also help a manager raise capital a lot faster rather than doing it themselves, which can be challenging in a fund.
We have a question here about if your fund has non-accredited investors, does that affect and limit it to the participants in the 506B syndication? Is it still 35? I think it's 35 people.
Yes. If you have a 506C, you cannot take any unaccredited investors. So if you plan to take non-accredited investors, you need to do it as a 506B.
Okay,
And
so it would remain the same whether it's in a fund or it's a syndication. Okay,
yeah, it's
perfect.
same rules that used to apply pre Jobs Act, right? That needs to be limited to 35 and so forth. And you cannot solicit or advertise. You have to have a prior business relationship.
Yeah.
The major challenge for a new fund manager is raising capital. I mean, it's just how do you raise enough money in the fund to justify doing it in the first place? I would say people routinely overestimate the amount of money that they're going to be able to raise in a fund. I certainly did in the beginning, and I'd say that is by far the more common occurrence, that people are think that the investors who invested in one deal at a time will just move over to the fund format. I find that some will, but many will not, because they can't pick and choose which assets they're investing in. So I encourage people, have a strategy on how you're going to raise the money. Ideally, have some people already committed to it before you launch it. Your capital sources, again, high net worths. You have your unaccredited investors and 506Bs. It's not on here, but family offices is a big one. And I would say some managers have what I would consider to be illusions about raising money from pension funds. But for small first-time managers, it's almost impossible to raise money from pension funds. Their requirements are too difficult, too big. And they only want to be a small percentage of the total, and they don't want to put out less than 20 or 30 or $40 million, and the math just doesn't work. So it's by far high net worth accredited investors is the biggest source. If you have a good way of raising capital and a proprietary means of doing it, that's a huge advantage. And I also encourage people to have, ideally, you've got two partners at least, one that focuses on the real estate, one that focuses on the capital raise side of the equation, because it's not an if you build it they will come scenario. That's for sure. I have some other comments here, but I mean, I see we're at the top of the hour. Maybe I'd open it up to questions here, Julie, and let me know if there's any.
I think launching a fund would be very helpful. If you could go back to that. I think there's a lot of people that, have investigated this or have thought, I know I have, said, I've got all of these people and I've got all of these different opportunities. How do I get all of these people in my court? And then I go out and shop for them. So launching, I think, would be super helpful.
Yeah, I think I would say step one is, okay, what is your deal flow? Like, how reliable is your deal flow? How big is your deal flow, right? And you need to have a certain size and scale of that and know that it's there. I've seen a lot of people launch funds and then not have the deals there. So that's kind of step one. I think if you have deal flow and you need to understand how you're going to raise money, or at least have a pretty good idea of that. And again, ideally, you've got some amount of money that you're very confident you're going to be able to raise. Having an investment offering, I'd say the process we follow, Julie, when we do these fund creation engagements, is we first draft term sheets. So we're not going to go in and draft an entire set of documents. I mean, we do have legal counsel that we hook people up with that do all of the legal component of it. But step one is let's get the structure nailed down, and then you can circulate that or soft circle it with investors to see, test the waters and see if you have some people that you think are going to be able to invest. Putting in some of your own capital is always helpful, right? Everybody, you guys all have heard how much skin in the game, thing. So the more you have, the better it is. And if you don't have it yourself, it's helpful to have somebody in the GP entity that is investing in there. I mean, you can bring on an investor partner, right, that comes in alongside you on the GP front. That's always very helpful in launching a fund, is to have somebody alongside you that does have some money in the deal. I mean, we have in there get ready to grind. It's like it's a lot of work. It's a time commitment, right? And it can last and will last for years. So be prepared to make a commitment to being involved in it. Building a list is really making sure you have a full list of, all right, how are you going to raise the money, right? There's marketing materials that you need to put together, pitch deck, a one pager. We have all kinds of suggestions in terms of like, what are the materials that you need to be able to do that. And then ultimately, again, if you have more than one partner, somebody who's focused on raising the capital, you need someone every day who's waking up and their mission is to raise money in that fund. Because if you have deal flow that you expect to be able to put capital into, you got to have the money. And then be patient, right? It takes time. I mean, I'd say start small and you can build up over time, right? You don't have to launch a giant fund the first time. It just needs to be big enough that it justifies the cost associated with it. But I say this a lot to people. It's like running a fund is a bit like having kids. You can read about it. You can babysit your niece and nephew. You can take parenting classes, but you never really know for sure what it's like to have kids until you've actually, had kids. So it's because it's a lot of work, and that's, so at some point you just, if you're ready, you just have to do it.
That is great information. What's the average cost to launch a fund?
I think if you want to go totally on the cheap, you could probably get it done for as little as 15 or 20 grand. If you want to, do it right, have everything done properly, all the consulting documents, the marketing material, everything, I'd say average is going to run you 30 to 50 is $1,000 is just to get it all set up and to be ready to launch. And then that's just to get to launch. Then you have, running it, there's all kinds of ways you can pay to go raise capital. If you're going to do fund administration, but that can be a fund expense, but that's something that investors like having a fund administrator, right? Because there's somebody there paying attention to the books. It's not just the manager telling them, hey, here's what the numbers are. There's someone actually signing off on them. So there's upfront costs and ongoing costs. But upfront, Julie, I'd say expect to spend, 35 to 50 grand.
Yeah, that's amazing information. Would that also be the legal fees that would set it up? That would include those?
Yeah, I mean, I've seen lots of people spend well over $100,000, which
Wow.
includes legal fees and everything. And so, I mean, you can easily spend 100, 150, 200 grand. I don't think you need to spend that much. I think you can get a full set of legal docs, all the consulting, the marketing materials, and at very high quality for 50 grand.
That's what I like about Verivest, because you've got the resources that you need that are not foofy. They are what it takes to get it done accurately. That's what I really found with your organization.
Yeah, I appreciate that.
So if someone you have that last slide there, thank you, slide. If someone wants to get a hold of you, how would they do it? Now you're at verivest.com, but if somebody wanted to have a conversation with you or wanted to engage Verivest, what would your recommendation be?
Well, you can certainly, I'm on LinkedIn. You can welcome to connect with me there it is a great place. But my email address, which I should have put on here, is Matt. It's first dot last. So my name right there, matt.burk@verivest.com.
Okay, I'll put that into the chat. All right, let's open it up. And we've got a couple of seconds here left for any other questions. I think you've been very accurate with all your information and very full of information, obviously. So anybody here have any questions? what do you call it? Greenfield fund? Where it just keeps going and you can't get out.
Well, we call it an evergreen fund.
Evergreen, yeah.
Yeah,
Are you,
evergreen means there's no set end date. It's just it goes on indefinite. I mean, in practical terms, it never does because it
yeah,
either will get sold and rolled up into a new fund or wound down or something. But yes, an evergreen fund does not have a set end date on it. That would typically be a mortgage pool fund that's open ended.
are you doing many of those these days?
We set some up for people for sure. Yeah.
Okay.
Yeah, we do. Especially an experienced manager that's been around a while. Yeah, there's nothing wrong with it. I mean, frankly, putting an end date on it sometimes works against you because as a manager,
Mm-hmm.
because then people sort of expect that to be the end date, and then they stop investing. And but putting an end date on it, you can always roll it into a new fund. That's what a lot of managers will do, right? They get to a point where, okay, we're stopped raising capital. We're just going to sell the assets from one fund to the other. You have to do a price and make sure that it's a fair price and so forth. But at that point, it's not really a blind pool because, the opening set of assets are something that you can show people.
Sure, sure.
That can be easier to get that one going.
Yeah, I've got a partner who is in an evergreen fund and can't get out of it. And they just keep rolling it on to the next one. And she wants to be done. And she's finding herself just stuck there and, maddening. All right. It
Yeah,
sounds like,
that's a whole nother topic of conversation
yeah,
for another night, Julie. But like,
sure.
there's tokenization that's coming down the pike, and being able to set up a secondary market for a lot of these private vehicles. I do think that's going to be something you'll see in the next, 5-10 years. It's still very early in the infancy of that technology, but because of the liquidity issue, it's going to be something that for sure people are going to be interested in.
Makes sense. Makes sense. Yeah. It's very challenging. All right. Any questions? Last 3, 2, 1. All right. Matt, fantastic. Thank you so much for all of this generous information. Really helpful. I've heard about funds probably 4 or 5 times, gone through presentations, and it's finally sinking in. It finally makes sense. So hopefully we've touched on some of the new people here that have never heard of this, or even some very seasoned investors that are saying, you know what, that is for me. So I appreciate that.